are not punished in any way if you didn't answer this, but this is a good way to usher you into learning unit 3. You need to be able to take these ratios, all of them, into one picture. So these ratios are puzzles of a picture, different parts of the different parts or puzzles of one picture. So don't take them in isolation. Look at the full picture. Does that make sense? And what I would ask you, the indication was there. Look at where the indication was there. Oh, sorry, where the indication was. It was about the creditors. So you will know that there is a problem here. The creditors. What is the creditor? It's our lenders, the people to whom we borrowed money, right? So then you need to say, let me look at the gearing ratio. Guys, remember, there was no question on gearing ratios, but in your exam, you'll find the gearing ratio. So you might have done well. That doesn't mean you should not prepare and understand what is gearing ratio. What I will ask you for all of you, guys, go take the debt to equity ratio and the total gearing ratio. Practice it. So see if you get the same thing as I. But I was able to quickly look at the long-term debt. Here it is. I was able to look at the long-term debt, which is the non-current liability, divided by the equity to find the debt to equity ratio. Quickly, I just took this one. Do you see it? Sorry, this one divided by this one. As simple as that, as quick as it is. So guys, remember, this is how fast we want you to be. Know these ratios, understand them. This one divided by this one for 2023, and then I took this one quickly divided by this one. For the total gearing ratio, you have to take the long-term debt divided by the capital employed, which is the long-term debt divided by the long-term debt, uh, long-term debt, long-term liability or long-term debt plus equity. So get these ratios in your mind and understand them. So you would get an indication that this company is highly geared, highly leveraged. It means that there's so much debt that they are using that the company is too risky. Other investors who would look at this would not want to invest in this company because it's too much, too much. And that's why the reason why they decided to decrease this long-term ratio, because it poses a risk. All right. So that was paper number 1. Any question? Makes sense. Okay, perfect. Basitswana, by the way, well done on your paper. Wonderful. Makes sense, Mogao. All right, guys, please, it doesn't mean stop here, don't do anything. I want you to go and do the calculations by yourself and understand that these ratios, when you see a ratio as a problem, it's giving you an indication that there is a problem there. All right? So do further investigation. If it's the creditors, there's a problem with the creditors, with settling the creditors, then look at debt, at gearing ratios, right? Gearing ratios. Gearing means debt, as you know, right, guys? Gearing ratios. All right. There we are. So let's quickly, it's not a long chapter. It's the smallest chapter. So I'm really happy to cover it quickly. As you remember, you need to remember your net working capital. Your net working capital speaks about your current asset and current liability. One thing that is good about this course and why you should be excited is that you've just seen we've gone from looking at the ratios and now we are delving deep into one specific aspect of it, which is the current liability and the current asset. Obviously, we use current liability to finance the working capital. Working capital, as if it was a capital that was the reason why we call it a working capital. We are talking about this conversion, this cycle from cash. We take cash, we use cash to buy inventory. Sometimes we buy that inventory on credit. Afterwards, we transform that inventory that we bought into cash again. So it is a cycle. And remember, it speaks about the short term, not the long term, right? We're going to look at the long term in other chapters. Right now, we want to focus on what we call the working capital. Remember the capital again? Capital. You would think about capital when you're looking at long-term assets. Capital, long-term. We take money. You are, okay, let me speak to you guys. You are an entrepreneur. You want to create a business, a company, and you need machineries. The reason why we're using manufacturing is because if you understand manufacturing and the logic behind manufacturing, you are able to understand the scientific method of how we run companies, right? So manufacturing, but it could be a service company. You are providing a service to people like a restaurant, but still you need to buy the ingredients, you need to buy short-term things so that they may be a working of the capital and it's short-term. The long-term capital will finance long-term things. So one thing that is very important, you want to finance long-term assets with long-term liability, not with short-term liability. You would like to finance short-term asset with short-term liability. You're not going to be selling your equipment, your very, very expensive equipment. And remember, you as an entrepreneur, you know that you will need sometimes to take a big loan to buy, almost you need to take a bond to buy a machine that you're going to be repaying over 20 years. So, but you don't want to be selling that big machine to pay short-term loans. That doesn't make sense, right? Guys, does that make sense? So do you get it? Do you get what working capital? And let me go deeper. We need to understand that within this flow of cash there is cash that coming in, there is cash that going out, right? So there is a cash inflow and a cash outflow because there's conversion of the inventory and datas into cash, all right? But those things can be hard to predict. You know when you have to pay your debt, your creditors. For example, if the bank is give you money, if you have a car, if you have a bond, you know at the end of the month you need to pay, right? So that is predictable. What is not predictable is that conversion. You don't know when the cash will come in because you have to rely on your customers. And that's the reason why we need to manage it. Whatever gives us uncertainty, we need to mitigate the risk by proper management. And you, as an entrepreneur, need to be aware of this. So, ensuring that the business is liquid enough, that there's a smooth operating cycle is very important. And that's what the primary objective of working capital management is. You want a smooth operating cycle. You also want an optimal operating cycle where there is a proper balance, right? You don't want to take too much on credit that you are not able to pay, right? You don't want to take also too little that you might run out of material or inventory. So if you have a manufacturing company, you know that you need, let's talk, for example, about um, Toyota in South Africa. We bring the parts, we assemble those parts, and we create a car. So you need the inventory, you need the different parts to come from different suppliers to come in so that you can assemble your car, right? So if you're taking too low, maybe you might run out of parts to assemble, and that can frustrate your customers because can you imagine Toyota is not able to build cars? Now people are not able to buy cars because, oh, there's a problem. Toyota ran out of parts. I mean, that's a scandal. You can't let that happen. So you need to look at an optimal where you don't take so many parts to build so many cars and people are not buying it and are not meeting the supply. Remember, supply and demand, that's your economics, right? Remember that? So there needs to be an optimal balance, right? Obviously, one very important thing is that you also need to minimize the interest rate. That's why we say, why is Solar Green taking so long to repay its debtors? There is a risk there because so not its debtor, to repay its creditors, sorry. There is a risk there because your lenders might be frustrated and you might run into risk, right? Where they're not giving you favorable. Remember, you want to get favorable credit terms where they give you good interest because they know that you are a good payer, right? And the final thing, obviously, we minimize the cost, but we want to optimize the return. So basically, if you've done this reading, guys, did you do this reading? Is everything fine with you? Do you understand this concept? All right. And you know, the higher the risk you take, the lower the potential the higher the risk you take, the higher the potential return. All right. Green, Solar Green was getting higher return because Solar Green was taking high risk. They were taking so much debt in order to run the business, and it was generating a lot of returns, right? Depending also on the industry, right? You must look, all the industries are not the same. But guys, very important, working capital ratio. Working capital ratio is similar to your current ratio, right? Remember current ratio? But working capital ratio, you need to adjust the percentage. Current asset divided by current liability multiplied by 100. Okay, it's also one ratio that we're using when we're looking at how the management. So why would we be using it? Is because we want to see how properly managed is the working capital. So the lower uh, 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 we want to avoid a risk of insolvency. That's a fact. We want to we want to be careful that we don't have more liability and less assets to settle those liability, right? Remember the balancing. Okay, now this is a good I'm gonna quickly jump here, guys. Do you understand this one? This is basically the whole these two are for you to see the difference between the different settlement periods. Remember, on this particular scenario one, everything is constant. You settle your creditors 1 month later. I'm going actually to use this. Do you see this one is settled 1 month later? All right. So you see it's settled 1 month later. How do we know that? It was provided to us here. Look at the notes. The note clearly tells you that it is company policy to settle all creditors after 30 days. After 30 days, as you can see, after 30 days, this is the month of March where we purchase things on credit, and the next month we need to settle. Do you get what I'm saying? But look at the credit sales. Remember, in this example, we assume that all sales are made on credit. And can you see here? Do you see that? The 200,000, we going to get the cash from our debtors after 2 months. How do we know that? It is given to us. The debtors were all collected after 60 days. That's it. There is no much that you need to look at what is given to you here. So read always carefully the notes that are provided to you. And basically what we want to find out is if we have constant sales and cost of sales, and if we would like to increase, meaning we want to get more profit. If we want to get more profit, we will buy more things on credit. So as you can see, there have been an increase here because we want to buy more things on credit, right? What is going to happen? So if we buy more things on credit, we generate more revenue, but there could be a problem that at the end of June, for this example, we receive nothing. Why is that? We're taking a risk, but we are also running into a risk of not being able to repay our creditors. Our cash balance is problematic, right? Why is that? It's because we are paying our creditor early, but receiving money from our debtors later. So that could lead us to change basically our policy so that we can receive also our debtors early, so that we can match maybe the settlement period, the creditor's settlement period with the debtor settlement period. Remember, you have to pay money, you have to take money and give it to the creditors while you have not yet received money from your debtors. No problem, Mugao. If you have to leave, you have to. Guys, if you have to leave, please leave. Remember that the recording is there, right? But like I said, this one is slightly a longer session, but we want to tackle this one quickly. Guys, is this making it's clear to you? So you need to manage your collection. Wonderful, wonderful, wonderful. So you need to manage you need to manage your periods, your collection periods, uh your creditors period. It's very important. So if properly managed, risk can lead you the higher risk you take can lead to higher return if properly managed. For example, if collection period is greater than the creditor settlement period, that's the risk that you are taking. But it needs to be properly managed. All right, so these are examples. I want you to go through these examples, very important, and to see, for example, for question 3.1 and question 3.2, I did provide, where is Easy's question? I did provide some extra, not sure if it's synced in yet. Yeah, question 3.2, I did provide some extra there. Where is it? Ah, there it is. So that was Easy's question. Easy, if you are struggling, I've added some more. Yes, I've added some more notes for this one. But you need to remember that the first thing that you calculate is the credit sales. You have the total sales. You need to find out from the total sales how much is on credit. And look at the notes. The notes should provide you all those things. They tell you that 75% of all sales are on credit. So basically, this on this table, when you're looking at the credit sales, this is how you will be drawing all of these tables. Seems to be frozen. Okay. So guys, let me just reshare this because they say that it seems to be frozen. Can you hear me? Oh, perfect. Easy. It seems like they can. Basetswana can hear me. Esther can hear me. Seems like. Can you hear me? Easy. I'm not sure. It might be your internet. Just check again your internet. Yes, you can now. All right. Okay. So guys, as you can see, the first thing that you need to do here, first thing is calculate your credit sales because we want to find out what the credit sales. Because normally we would say that you have to repay your creditors in 60 days, but it does not necessarily work that way in practice, right? Companies will say to, basically like when you repay a debt, every month you have to pay something. So when it comes to companies, there will be a certain percentage that you need to pay in the first settlement, in the second settlement, in the third settlement. That's how you need to understand it, right? So this is a good example of that. Whether it's things that you are purchasing on credit or things that they are buying from you on credit, right? So here it is that 75% of whatever sales you have is on credit. So all calculate from January to August, sorry. From January to August, calculate what is the credit sales. You will do the total sales, for example, this one, 440,000 multiplied by 75% or multiply by, let me write this here, multiply by 0.75. So you take the total sales multiply by 0.5, you will find all the credit sales from January to August. That's how you find it. Now you need to look at the cash collection from data, all right? They say 40% of the outstanding amount. So 40% of these amounts, yeah, of this amount, 40% will come after the first month. So after January, it's February. In February, you need to pay 40% of the credit sales. But look here, look carefully that this starts from May. So for January, February won't be there on this schedule. It won't be there. You must look at where it's starting. The budgeted start in May. So the budgeted sales start in May. So we are sitting actually in April. So we have January, February, March, April. This is the actual. It's not budgeted. So then remember, in your theory, we always do budgeting forward, looking forward. So we say, okay, we are in April. We're going to budget for May. We're going to budget for June. We're going to budget for July based on past information. We're going to budget for the future, right? So that's what it means here. And so we want to find out what will be the cash inflow. How much money are we going to get from May to September, October, right? So we have May here, June, July, as you can see. Are you able to see, guys? Yes. So we have May. Remember again, we are looking at the budgeted because we don't know how much. We are talking about the future. We're just making a budget that, okay, we know what is the percentage that we buy on credit, and we want to tell our the percentage that we buy, that is bought from us on credit. So our daters, remember, there is purchases and there is sales. Sales, it's people who are buying from us on credit. Purchases, it's we who are buying things from people on credit. That will be our cost of sales, right? We buy the merchandise from our creditors, our suppliers, and we sell it to our clients. And some of our clients buy things not cash, but they pay on credit. So there is a portion of this 440,000 that is cash, which is 25% only cash. 75% is on credit, where we agree with our daters that you're going to pay us in after the month where you take things on credit. After that month, the second month, you must pay us 40% of what you owe us. The third month, you must pay us 35% of what you owe us. And the last month, the third month, you must pay us 22%. Okay, Easy want me to say that again. All right. Okay, so I'm going to repeat it. Oh, you're writing. All right. No, Easy, please, you're going to go back to the recording. You have the recording. I'll provide you the recording. But let me say it another way, but now for purchases. Remember, we purchasing things from our suppliers. Easy, Esther are running a company, a retail company. They buy merchandise from suppliers. They give some cash. A part of the money they owe, they give part of it, they pay cash. The other part, they take on credit. 40% of all purchases are on credit, meaning that 60% Easy, Basetswana, Esther are running their company. They pay cash 60%. The 40% is on credit. And there is an agreement between you and your suppliers who are supplying you the merchandise. You agree that within 30 days, you're going to pay the outstanding 65% of the purchase credit. Remember, you purchase things on credits. That amount, that 40% of all purchases is on credit. Now, 60% of the money you owe, not of the total. 60% of the money you owe. That 40% is the money you owe. 65% of that 40%, you need to pay it pay back within 30 days. So that will be your first settlement. So within 30 days, you need to pay 65%. And if you pay early, you get a discount of 5%, right? So from the 65, you need to take 5% out, not 60. So you have 65%. Let me do for you the calculation here for all of you who are watching. So you have 65%. Nope, not a heart there. Uh, okay, so this is 65%, right, guys? Are you seeing? So 65%. So you must minus 5%. So you're going to multiply this 65%. 100% minus 5% gives you what? 95%. Exactly. So you are 95% as a decimal is 0.95. Oops. Sorry. Let me make it bigger. Let me make it bigger. Don't worry. 0.95. So guys, as you can see, 0.95. So you're going to multiply this 95% by 0.95. So just to take into account the discount. All right. So do you have your calculators there? Okay, let's work together, guys. We must be practical. Please take your calculator. Don't just be looking with your eyes. Take your calculator and do this calculation with me. Exactly. So basically, for those who are paying early, which would be those who are going to pay within 30 days, actually they will pay not 65 but 61.75% of the credit purchase. Remember, it's the credit purchase. This is what you need to pay your your suppliers of merchandise, Easy, Esther. This is what you need to pay them within, because they gave you even a discount, because remember, they want to encourage you to make your payments. And the balance, look at the balance here of 35%, 35% of the debt, not 35% of the entire purchase. Remember, because the purchase is made out of two things: cash and credit. Credit is the debt. So 40% is, so calculate like you've done here. You see, for credit sales, we first calculate for the credit sales, we first calculate what is the credit sales itself. Once you calculate, which is multiplied by 75%, then you get your credit sales. And then you now can start doing this calculation of 40% of these credit sales, 35% of these credit sales But now you must remember which months you have to put it. Remember, in January, you pay in February 40%. In March, you pay 35%. In April, you pay 22%. In May, there is only that 3%. Am I right? That is unrecoverable. So you go from for January that, but we don't have on this table, we're starting from May upward. That's why you don't see for January, February, March, April. We don't need it because we have the actual figures. What we budgeted for was from May upwards. That's why we put this table starting from May upward to see how much collection we're going to make in May, how much collection we're going to make in June, how much collection we're going to make in July, etc. Does that make sense? Kinda. All right. But in any case, you know the drill. No, guys, you know the drill. You know the drill. The drill is go practice this question. And if genuinely you're struggling with this question, book a session with me this week. Let's take this question, you and I, and let's work through it together. Okay? If you are struggling, if you're not struggling, move forward, right? So, but take this question. Okay, go over it. Wonderful. Go over it. So basically, that's it. That will be the big thing. This, guys, it's not a waste of time. You're gonna get it in your exam. You will get it in your exam. It's going to be there. So do this example by yourself. Follow also the steps that I've provided you. After the sales month, so if you sold things in January, after the sales month, the second month will be February. If you've sold things in May, the first month is May. The second month is wait a minute. No, the second month, the first month is, sorry, the first month is June. All right. The second month is actually July, right? Just make that sure there. Okay, and remember again, it is in the reading. Just make sure that the 40% is in the second month following the month which the sale took place, right? Okay, so in May, the sale took place, the sales took place in May. We skip June, we go to July. All right, the second month after the month, after the month. That's English, pure English, right? May, after the month of May, skip the 1 month, you go to the second month. So May, you skip June, you go to July. In July, you must collect 40% of the credit sale. How much is the credit sale? 487. Is this bigger enough? Let me see if I can make it bigger. Right, in any case. So if you see here, 487,500, that's the credit sale for May. 40% of 487 will give you 195. Does that make sense? Yes. So I can show it to you here. 487,000. Is it 1,000? Yes, 487. Is it that for May? Is it for May? What is the credit sales? we calculated it. The credit sales, you see, we took May. May was, okay, let me start in case somebody is struggling. 600 and this was the total sales budgeted. We budgeted that we're going to get this money. What is the credit sales? Is 75% of this. That's the credit sales. This is what we will owe. And it fits exactly with that. Do you see that? Do you see? This is the credit sales. Now, we are in May. We need to skip June. In July, we need to pay 40%. So we're going to calculate now 40% of this. 40% of this, 195. Here you can see in July, 195. What is going to happen in August? We're going to pay 35% of this 487,000. That's what we're going to pay. Do you understand now? So this is very, very important. But remember, it is technical, so you need to practice. And I want you to practice that. Guys, practice also this question. I want you to do question 3.3. If anyone can do question 3.3, please send to me the recording. Guys, we're going to come now to our last section. Very important. The cost of money. What is the cost of money? It is the interest. That's what we're talking about. And if you've done this reading, it's quite clear to you. Basically, in South Africa, the benchmark interest rate is the prime overdraft rate. And what is it made of? So basically, there is something we call the repo rate. The South African Reserve Bank is the big boss that provide money to all the banks. Now, they provide that money at a repo rate. And now those banks will add 3 to 3.5% over that repo rate. So if the repo rate is 10%, they're going to add 3% or 3.5%, which is going to be 13%, right? That 3% is the interest that the banks are going to get. That's the money. That's why they are in business, right? So whatever business that you are running, you need to consider that the prime. The prime is something that you know quite well, because if you take a bond, you are paying the prime to repay the money on your bonds, right? But that's not the same when it comes to companies. Companies include more risk, and that's why it's different from the prime. They need to give a bigger interest, right, for companies. But you need to understand the difference between a nominal rate and an effective rate. Companies, sometimes a bank sometimes will quote you on the nominal rate, but it's very important to understand what is the compounding period, right? Is it an annual compounding interest rate? So this is where basically we study the future value of money, right? And this is quite a good example for you to go through, right? Because you have 1,000 rands and they give you a 10% interest rate. How do you calculate? At the end of 1 year, you have 1,000 rand, you invested. At the end of 1 year, you will have 1,100 rand. Is that clear? That's simple, right? 10% of 1,000 is 100 rand. At the end of the year, you have your 100 rand plus one more 100 rand. Sorry, your 1,000 rand plus 100 rand gives you 1,100 rand. Wonderful, wonderful. If guys, you have to leave, let me finish this because this is quite important. So this is the future value of money, right? But now what is the compounding? Now in the compounding is that in the second year, you will get interest not on the 1,000 rand, but on the 1,100 rand. So you will take 1,100 rand, multiply by 10%, right? To get the interest, right? So it's very important to understand it. In other words, the compound interest is the interest on the interest. I hope that that's clear now. The compound interest, it is the interest on the interest, right? So this is a good example. Guys, go through this and practice this because it touches on one of the most important topic in finance, the future value for money.